Today we're going to look at a couple things regarding their composition. So here we're talking about market indexes or indices. You might hear this term all the time, like the S&P index or index funds and all of that sort of stuff. But what is a market index in the first place? I always like to say it's basically just a list. It's a list of a bunch of different components that are supposed to well represent some area or some market. So here we see that it's used by investors and fund managers as a tool to evaluate the performance of a stock market. So it's like if I want to say, how good are financial companies doing? How good are banks doing? I might look at a financials index because it's going to include a lot of companies that fall into that category. Or if I want to know how technology is doing, and if you know how technology is doing, it's down a lot right now. But if you look at a technology index, it's going to have a lot of those companies that you're familiar with. Meta, Apple, NVIDIA, it's just going to be those familiar names because they're the technology companies. And the index is used to represent that sector or that section of the economy or some marketplace. So a market index fund tracks the performance of a specific grouping of securities considered to represent some market or sector of the US stock market or economies or international or anywhere really in the world. So there's three major indices that you'll usually hear talked about. And the first one is the one that pretty much everybody knows, which is the Standard & Poor's 500 or the S&P 500. So this uses market capitalization, which is basically when you take the amount of outstanding shares for a company and you multiply it by that share's market value, there's your market capitalization. It's basically a way to say how big the company is. So the Standard & Poor's 500 is essentially saying we're looking at the top 500 biggest companies in the United States, and we're going to make a list of that. Yes. Yes, it does change over time because oftentimes, particularly at the bottom of the list, you have a company that just barely makes the cut and then it might drop off later and then somebody else will take its place. So these indexes do change, but it will all depend on what is being used to categorize the index. So if we're looking at some other technology index or if we're looking at the bottom of a certain range of stocks, that might be different than the Standard & Poor's that looks at the top. Or if you're looking at something like the Dow Jones Industrial Average, this is a stock market index that tracks 30 large publicly owned blue chip companies trading on the New York Stock Exchange. And it's just 30 specific companies. Like the people at Dow Jones, they chose these because they think they represent the market index pretty well, or at least they did at that time. And the NASDAQ 100 is a collection of the 100 largest, most actively traded companies listed on the NASDAQ stock exchange. So you'll have a couple different stock exchanges. For the most part, we're not really concerned about all of these different places that you could trade, but the two main exchanges, which is where you can exchange stocks with people, would be the NASDAQ stock exchange and the New York Stock Exchange. So the NASDAQ 100 is simply saying, I'm only looking at this place over here where all of these stocks are, and that's the 100 largest companies. Again, market capitalization weighed. So those are a couple examples. Oh, yes.
Are the same companies in all three, or are they very different?
So there will be some similar companies in all three of these, but the NASDAQ list tends to, I'm not really sure why, but it tends to be more tech focused. Those just happen to be more companies that are in the technology sector. Standard & Poor's also has a lot of tech. And the main reason for that is because tech companies, their share prices increase by a lot when they do increase, because the value is not determined by, say, the dividend or the earnings. It's like, it's more of a hype or like how big is this in the technology space? It's just a big growth thing. So oftentimes the NASDAQ and the Standard & Poor's will be very similar, yes. So it's not exactly the same measurement. So this will be those companies that are traded most which honestly will be very similar in terms of the composition. It will be very similar, the list of companies that you'll see on the NASDAQ 100 versus the Standard & Poor's 500. In fact, I'm curious how many of those 100 actually fall within the S&P 500. Probably a lot, if not maybe all of them.
Yeah, mostly tech stocks.
Yeah, mostly tech.
The reason was at the time that the New York Stock Exchange, they wanted a quotation system you could get on your computer first rather than go to the floor. And that was mostly smaller companies, and most of them were tech.
Gotcha. So a couple additional ones that we've got as well. There's way more than this. There's hundreds, thousands of indexes that you could look at. But a couple extra ones that we can look at are, one, the NYSE composite, which is just really all the stocks on the New York Stock Exchange. If you were looking at the New York Stock Exchange, this composite list is just every single one. So it's kind of a cool way to think about what is the overall market doing today. If I looked at everything and I didn't bias towards those largest companies, I just looked at every single stock, how are they all doing? The Russell 2000 measures the performance of 2,000 smaller companies included in the Russell 3000. So Russell makes a lot of indices like that, a lot of different categories. Yes.
Is ETFs, any of those, is that totally a separate deal?
So an ETF is an actual product. An index is not a product. An index is just kind of it's a list of other things that are included. So if I say I'm looking at an index, you can't actually buy an index, but you can buy a fund that tracks the index. So it's more of the data point rather than an actual product. It's like, this is the data that I'm looking at. It's the 500 biggest companies on the whatever stock exchange. And if I want to buy all of those, I could go buy each one myself, or I could go to another provider that says, listen, I've made that into a single product. That would be your index ETF. And then you just buy that and it represents that because they've done the work of buying all the individual stocks. So that's basically how that works. Another one would be the FTSE 100, which is from the Financial Times Stock Exchange Group. And this is basically Britain's main, it's kind of like Britain's version of the S&P 500. It's pretty much the same thing there. And this group specializes in providing index offerings for global financial markets, not just the US. So kind of to that point, if we look at fund strategies, we've got a bunch of different things that funds can do. I mean, mutual funds and ETFs can really do pretty much whatever they want as long as the SEC says it's all good. So starting with that, we can have index funds. So if we have our product, like our mutual fund or our ETF, they can decide, I want to track that market index because a lot of people want that. Everybody wants an S&P 500 fund, and everybody has an S&P 500 fund. Vanguard has one, Schwab has one, Fidelity has one, SPDR has one. Everybody has a S&P 500 fund. So you'll see a bunch of examples of that, and pretty much everybody's just beaten to be the lowest cost. And everybody wants that fund because it always seems to be one of the lead performers. Yes, exactly. Yeah, so oftentimes one of the reasons why multiples might exist is because some of those fund companies like Schwab and Vanguard and Fidelity also have brokerage accounts. So they also are in the business of letting people trade and hold their assets there. So if you go to Schwab and then say, I want the Schwab fund, they're probably going to charge you a lot less because at the high level, that fund is making money for you having your money in there. So there's kind of like a beneficial thing. So exactly, it's likely that you probably won't pay trading commissions. Sometimes Fidelity even has loss leader funds where they don't charge anything for fund management because they hope that you move your money over there for that fund, then use all their products and services and maybe start buying some more expensive stuff. It's very similar to kind of like, retail stores and whatnot.
Fidelity has no charge for their S&P 500.
I'm not sure if it's specifically for their S&P 500. I forget which funds they are, but there are some, that's their total market. But there are, yeah, there's like a category of free funds that they have. Right, exactly. Yeah. We're next. Pretty much.
The index provider weighs out, if a company goes up or down in value, then that can change the allocation a little bit.
Right.
And they put it out and everybody's got to follow that and they have to do that. The ETF and the mutual fund have a fractional difference in their allocation, right?
The teeniest, tiniest little difference. So the only difference is that you'll usually see in something like an S&P index fund is there might be the tiniest amount of cash in there to pay for expenses of the fund. And there might be a little change that happens in the market that they don't catch on for a day or a week, tiny little bit, and that's what you would call tracking error. So if they don't follow it perfectly, that little difference would be tracking error. But for the most part, the long-term return results end up being nearly identical.
They need a little cash for liquidations if people aren't buying it.
Not for ETFs.
Oh, not ETFs.
Right.
Fund.
For a mutual fund, yes.
Yeah.
So for a mutual fund, sometimes they'll have to have some cash in there because when you buy and sell a mutual fund, when you sell it, you're basically redeeming your shares from the company. So they're the ones that are giving you the money rather than you're selling your share to somebody else. So they have to be able to provide those funds to you instead of just you sell your share to David down the street.
Okay, I'm gonna ask a little bit.
Sure.
So why does the Schwab fund, which has the same as the Vanguard,
Mhm.
or why is the difference in the stock price?
Sorry.
In the
Share price.
Oh, if they have different share prices.
Yeah.
So
Good question, good
It
question.
would be the number,
Dumb question.
the number of shares outstanding and the shareholder.
right, but so each fund could have a different share price, right? So like Vanguard versus Schwab versus Fidelity, and I think that probably I don't have the exact answer for you, but my best educated guess is going to be where they started from. So they might have said we're going to launch our fund with a share price of $100, or we're going to launch our fund with a share price of $50. So depending on where they started, then all of the movement up and down will just be from that point.
And the number of
'Cause-
shares.
Shares outstanding
Yeah.
is going to cost less if there's more shares outstanding.
Well, the price per share might be less, but there might be more or less shares. So you're not getting a benefit from going Schwab to the Vanguard or anything. So it's the number of shareholders divided by the dollars that are in the portfolio allocated by the weighting of the stock. So,
So there's more shareholders in the Schwab.
yeah, most likely, yeah, something.
Yeah, so it's kind of one of those things where there's a difference, but there's like basically no effect unless you have less dollars to buy shares and you
put
can't.
$10,000 in one moment, whatever you get out is gonna be the same as all the other funds.
Right.
Yeah.
And then the difference, the ETF might have no cash in it because they don't need any cash reserves. If you want out, you gotta go sell to somebody else. The fund has a little bit of cash because if the market tanks and people get worried and they want their money, they've gotta have some cash to liquidate them because they don't wanna have to go inside and sell all the stocks.
Yes.
So, from listening to what you just said, so if the index moves like 50 cents, each one of those companies' shares goes up 50 cents?
No.
Not by 50 cents. It'll go up the same percent. So it won't go up the same price because the index kind of, it's like an average of everything together versus, like I said, if they launch the fund and say you can pay $100 for the share, the index price is 4,500, but the share price is 100. Percentage wise, they'll both move up and down the same, but they just decided this is the price point we're starting with just arbitrarily.
Yeah, similar to if you own a stock and if they split it and give you 2 shares instead of 1, unless popularity goes up and the price goes up, you still have the same value, but you have twice as many shares. It's confusing.
Yeah, exactly. So a couple examples of those index funds would be super popular ones like SPY. That's your S&P 500 index fund from SPDR. QQQ, which would be a NASDAQ 100 ETF, and I can't remember who that's from. Invesco, right, Invesco. FSKAX is a total market mutual fund from Fidelity. It's one of the lowest cost total market funds that you can get. And spoiler alert, the S&P 500 and total market funds perform almost exactly most of the time because most of the stock market performance is driven from those giant companies because they're weighted in the same way. So if you have a total market fund that's weighted the same way where the biggest companies get most of the weighting, then if you have like a top 500 versus all 4,000, because all of those other companies are so small, the effect is very minimal. So then the overtime charts look very similar. And then another one, which is not a stock market index, but a bond market index, is AGG, which is basically just an aggregate of all the bonds that are available. And I believe they're investment grade, but it's just an aggregate of the bond market. So after we move out of index funds, you can kind of consider index funds to be a subcategory of this following one, but I like to break it out because index funds are very specific and popular. Next, we move to passively managed. So this is something where there's not a lot of internal turnover for the most part. Mostly they start with initial allocation and it doesn't change a lot. But what they'll do is they'll use qualitative and or quantitative factors, so different things about the securities, about the stocks, about the bonds to narrow their selection from some other index or group. So kind of what you mentioned a little bit ago where you were thinking, so don't they choose the best ones? The index fund may not, but another, what would be called a factor fund, might look at that same S&P index and go, based on these three qualities that we determine to be a way to measure the value of a company, we're going to use those, and anything that falls outside of what we determine, we're not going to buy, and anything that falls within, we will. So they might lower their selection from the 500 down to 100 or 150 or 72 or however they determine that. So that would be a way that they go, we think these factors make a better company, so we're just going to buy those versus everything in the index. No. So small, mid, and large cap refers to the size of a company. So S&P 500 will be large cap stocks because those are the largest stocks, so they all are going to fit into large cap. I forget what the exact numbers are, but large cap companies have a market capitalization of 10 billion and higher. Mid cap is 2 billion to 10 billion. And then I forget where small starts, but it's 2 billion and a little bit less than that. Then you've got micro and nano and super small. A specific example of a passively managed fund like a factor fund, the one that comes to mind for me right now is called FELG. It's Fidelity's Enhanced Large Cap Growth Fund. I don't remember what their exact process is, but there's also things like, I think XSMO, which I believe is a small cap momentum factor fund. So they basically look at a small cap index and whatever their proprietary momentum measurement is, they apply that and then go, I'm going to choose those. And I think those are better. Yeah.
So passively managed, I'm assuming be less cost, plus they probably don't monitor it as much as
Right.
an actively managed one.
Right. So for the most part, the cost directly goes up as we move down this list, usually. And that's just a lot of because the passively managed is somewhat automated in a way. Like the overall strategy was developed and researched and all this active stuff, and then they set it in and they go, okay, now we can just allow our computer programs to use the inputs we gave it to choose the stocks based on whatever list we're looking at. Yeah. So they might adjust their strategy over time. It's not just like we said it once and forget about it. Let them. We're going to go to the next thing. There will still be continuous management, but it just might not be as hands-on or quite as like experience-driven versus the actual quantitative values that they determine initially. So moving on then to actively managed. This is basically when we get to your idea of somebody trying to outsmart the market or move in some way and use their experience to choose the securities within it. So the fund managers will actively watch the current market conditions constantly and attempt to capitalize on opportunities that align with the fund's stated objective. So for the most part, these actively managed funds can do mostly what they'd like to, but usually it falls within a stated objective. They state initially, this is what this fund is for. This is our capital appreciation fund or our growth fund, or maybe it's our income fund. So they're going to follow the stated objective that they said they were going to follow, and they're going to try and pick things that fit within that and best serve their shareholders following that objective. So an example of that could be something like a very common one that we've seen people hold for a long time would be T. Rowe Price Capital Appreciation Fund. That's been a really well-performing actively managed fund for a long time. PIMCO's Income Fund, ticker PIMIX, has also been one. Fidelity has a Total Bond Fund, FBND. These are just a couple examples of a lot of different things that you can find out there in the market. That's the PIMCO Income Fund, which is pretty much I would not be surprised at all. It's a very popular fund and it's very well rated. It's performed really well compared to its peers.
PIMCO stands for Pacific Investment Management Company.
Oh,
They're at Huntington Beach or somewhere down there.
Yeah. So after talking about these strategies, one thing that we've kind of touched on a few times, but we haven't quite dove into yet is what the difference between mutual funds and ETFs are at all. So they are both, as you can see, they both pool money from investors to buy investments. Though they do it in slightly different ways, that's kind of the key concept of what happens here. Most of the time they provide diversification, although there is such thing as a single stock ETF. And they can hold a wide variety of different investments. And sometimes they can hold investments that you can't hold on your own, that you don't have access to, but they can pool it in a product and sell you access that way. Now with mutual funds, they're bought and sold once per day. Because you're buying and selling from the mutual fund itself, the value is determined based on the value of everything within the mutual fund. It's like a raw computation of all the stocks and bonds that are inside the mutual fund. If you average that out for all the shares, that's the value of the share. So instead of having to do that calculation constantly, what the mutual fund will do is they'll wait until the end of the day to process your order. And then they look at the fund and they go, all right, what's the value of everything after market close? Divide that up across all of our shares. All right, this is how much we're giving to people who sold today. So then they'll determine that price per share, then it sells, and then the next day you see the money in your account. Oftentimes, mutual funds are where you'll find active management, although I will say that's changing a lot now in the last few years and moving forward. More and more ETFs will be active as well, but that's just kind of how we started, was mutual funds were the active, ETF were the passive. And the mutual funds, again, the prices are set once per day after the market closes because they look at everything that's inside them. If we move over to an ETF, they can be actively bought and sold throughout the day, because the mutual fund isn't the one who's telling you what it's worth. It's everybody else in the marketplace who wants a piece of the same thing. So technically, ETFs can trade at premiums and at discounts to what's called net asset value. Net asset value is the figure that is used to calculate the value of a mutual fund, because it's basically saying all of the assets that are in here, subtract any liabilities that we have, that's the net value of all the assets in our fund. So mutual funds, their share price is just completely based off of that net asset value. Versus with ETFs, it's really about what is the person next to me willing to pay me for that. Oftentimes, if it's a very popular fund or it's traded a lot, it's going to be really close to net asset value, because nobody wants to pay a premium for an S&P 500 fund. That just wouldn't make any sense. They could go to the next broker and buy it for the right price, or go to a mutual fund. So there's no reason for somebody to pay a premium or a discount for an S&P 500 ETF. But if it's a very not highly traded, super like hush in the corner sort of thing, it might be trading in a wild premium or super low. So oftentimes, like I said, these are usually passively managed, but that seems to be changing nowadays. And prices go up and down throughout the day because they're traded just like stocks. Because I can buy and sell just with whoever for whatever they're willing to pay me. I don't have to wait for the mutual fund, or I don't have to wait for the ETF to tell me how much it's worth. It's worth what David's going to pay for it. That's it. Point blank period. Just like a stock. Sure.
So you said there were three strategies: the index funds, the passively managed, and the actively managed. So the passively managed are the mutual funds, are not the ETFs, and the actively managed are the mutual funds.
So that's how it started. Nowadays, that's kind of different, and index, passive, and active can be either of the two.
Passively means like there's a computer program that keeps it all balanced.
It's kind of like,
But actively, there's a person taking this every day. I don't know.
yeah, so you can kind of think of it as like passively managed is like you're riding on a roller coaster. They built it ahead of you and you just get on it and you follow the path until you get to the end. Versus actively managed is like you get to drive the car. You get to determine whether you take right or left turns. So that manager is determining every single day, every time they get together, what stocks are we going to buy and sell. He's not listening to some sort of quantitative process that was laid out ahead of him. But in the passively managed, they set rules and they follow those rules pretty much. Yeah.
Better. You like better.
I like passively managed because historically, actively, I like ETFs versus mutual funds, but that doesn't necessarily mean a passive is not just an ETF. It could be a mutual fund. There are index funds that are mutual funds. And because they're index funds, I would consider that a passive strategy because nobody's really doing anything. There are active ETFs that they can be doing what they like to. They can do what they want as long as it follows the strategy. So active and passive is not strictly mutual fund or ETF. It's just more a category of what are they doing with the money from just looking at it. Yeah, yeah. Oftentimes the easiest tell is the fee. That's usually the easiest tell. So if I see a fee that's above 0.5%, it's probably not a passive fund. Or if it is, it's some like the early Bitcoin funds where they were able to just charge 2% because nobody else was doing it. But for the most part, super high fees, usually that means an active fund. Lower fees, usually that means a passive fund. Yes.
Okay, so going back to actively managed, it seems to me like historically, you would have had to have skilled investors making those decisions.
Yep.
Now I just help but wonder how much these, artificial intelligence, or algorithms or whatever, maybe they are all gonna have the same information.
Right. So everybody does have all the same information already, because if they didn't, it would be illegal because that's insider trading. So pretty much everybody has access to the same information. The big firms usually just get it faster than we do. It's just a speed thing. And if you look historically at a lot, there's maybe a handful of actively managed funds that have tended to do well compared to their peers and their categories over time. Most managers do well in certain environments and then do really poorly in others. So it balances out to be less than the index fund usually anyway. Most active managers are not very good for very long. They might be really good in a very specific environment, or they just hit a really big trade that does amazing. But usually the active management comes out in bond funds. So
The most important thing you can do is allocate appropriately based on your risk tolerance and objectives, like he's talking about. That's more important because a hedge fund manager might be good only because he or she gambled your money and they happened to get lucky and they were right a couple times. We're not into gambling. The managed funds Nash will use is mainly because they have insight, like bond funds he'll talk about.
yeah.
Or if they have a good strategy, but it doesn't mean that they know what's gonna happen tomorrow. If you invest thinking that this is a really smart person, they can outguess the market, good luck. It doesn't work. But if it's a good managed fund doing things that you can't just do in an index, like bonds, or let's say you did Bitcoin, I want somebody familiar with that arena, that's okay, and it's worth paying the fee.
Yeah.
I think you guys so far with AI, how are you feeling? Have they been pretty good, or are they pretty controlled as far as maybe being conservative?
Well, so in what sort of facet are we talking about with AI? Like, are we
Just tracking them so far, have they been spot on stuff, do you think, as far as adjusting to the market? That makes sense?
do you mean as like managing investments, or do you mean as an investment? Like, I'm still kind of confused on your question. So,
Because that's more of the passive.
Right.
Is AI.
Yeah, AI helps big corporations make a lot more money because they can keep you in a range of positions. If it could take your blood pressure and your heart rate and find out more about you, and then we get a better fix, because should I get out of the market or get into the market, that's based on how you're gonna tolerate the ups and the downs. So I'm not saying AI is it is more efficient. Nash and Shaniqua use AI in that
Personally.
yeah, but it'll get created to where it's more retail for you and I to use if we're not quite as experienced. But there are a lot of financial advisors that are passive. They put you in a bucket and the computer reallocates automatically and they get all the credit. But it'd be better if you had somebody do it, make sure that they're actively looking at your risk tolerance and your needs, or you need to do that.
yeah, so one thing that I will kind of say is kind of related to that is where we started, and we didn't call it AI, but you have what people know as robo-advisors. So it's kind of like, you can kind of think as a robo-advisor as like a factor fund, as if it were a financial advisor, where it just looks at you, asks you questions based on your input, it's going to adjust the allocation accordingly, which it's basically doing the job of the financial advisor, just without it's in terms of the investment portfolio, without maybe some of the more personal touch and really making sure that it's accurate what you're telling me, because that's a big part of the job, is to make sure that what you're saying is actually reflecting of what you feel and believe. But I would say that AI is probably going to become just an extension of that. And I would imagine that AI is not going to take place in fund selection for a little while, because that's going to be a compliance nightmare for any firm. So it may exist on the small bit, maybe with people making YouTube videos of having it run their brokerage account or something, but it's difficult to see that make a big stride in our sort of business, just because of how strict you have to be about your compliance and following SEC regulations and all that. It's a weird area, big gray area right now. So it's kind of hard to tell. Sure. So, okay. So looking again at ETFs, again, ETF shares represent a piece of the pool of investments, and you can buy your ETF shares directly through your brokerage firm like Fidelity, TD Ameritrade, Schwab. Same thing for the mutual funds, but the transaction for ETFs is between usually you and individual people or some other firms that hold a bunch of the shares. So with ETFs, you're buying and selling shares from another investor or market maker. Why might you like ETFs? ETFs trade throughout the day like stocks, which is nice if you like to move in and out throughout the day. Usually that's not going to make a statistical difference in your investment plan, but it's nice to feel like I want to make this change today and I don't want to forget, so I can sell out and buy in today, be done with it. I don't have to come back tomorrow when my mutual fund sells. Now, the next little thing, which is actually pretty nice, and I use this when I'm working with client accounts, is they can be tax advantaged when compared to a comparable mutual fund. Now, the reason for that is mutual funds can do something that's called a capital gains distribution. With mutual funds, because you buy and sell directly with the company, it's like you're a little bit more involved, and it's almost more like a pass-through business in a way. So if the mutual fund, say they buy a stock and it runs up by a whole bunch, and then they sell it at the end of the year, and if they don't have losses to offset that, just like you might in your own brokerage account, those capital gains will actually get sent out to you as the shareholder, and that's a taxable event. So if they make a whole bunch of money, they make these capital gains, they sell, and then they send that money out to you. That comes to you, that makes a current tax liability, and then it goes back into your investment, or you can take it as cash, and that's a taxable event for you. Now with exchange traded funds, they don't do this 99.99% of the time, simply because of some differences in how they operate inside. And that just has to do with how they acquire stocks and bonds and whatnot. A mutual fund actually buys and sells the stocks. They go into the market and they buy a big collection of stocks to add to their fund, or they sell them when they're done with it. An ETF, on the other hand, they'll be able to work with a market maker or who's called an authorized participant and say, I want your Apple, I've got a bunch of Microsoft, can we make a switch? And because they're just switching them back and forth, there's no sale. Nobody sold any stock, nobody bought any stock, so there's no taxable consequence. The value's still there because they exchanged equivalent values. So I give you my $100,000 worth of Microsoft, you give me $100,000 worth of Apple. No taxable event occurs, but we get to get that new investment and offload the one that we think is done. So that's why ETFs can be slightly tax advantaged when compared to. So they can also, just like how you can balance gains and losses against each other and not have taxes at the end of the year, they can do the same thing.
If I sell my shares, I file a capital gain, aren't I being taxed twice?
No. So if they distribute the capital gains out to you, you pay taxes on that money then whatever that was distributed, that's not going to be taxed again. You'll just get taxed on if that increases in value more. So if they send you out $100, you pay taxes on it, okay, then you reinvest it. If it increases by more, that part will be all that's taxable, plus whatever else. Right, exactly. So if you reinvest it, it just increases your cost basis by however much they sent you, because you had to pay taxes on it currently that year. So with mutual funds, a lot of the same stuff I talked about. They're bought and sold from the fund company, even if it's through your brokerage account. But one thing that is kind of nice is if you like round numbers, mutual funds, you can just say $1,000 even, and they'll give you $1,000 even worth of shares, fractional shares, to make it the right amount for you. With ETFs, you have to buy and sell whole shares because you can't split them up fractionally unless you're with a brokerage firm that does that, but we're just talking about the actual product here. So why might you like mutual funds? you might be looking for a specific exposure in a strategy that's not available in an ETF form, or you could be looking for a successful mutual fund that's lasted for a really long time and they just haven't ported over to the new product type. Like the PIMCO Income Fund or some Cohen and Steers funds that are really great, they just are only available in mutual funds. There's nothing wrong with that. That's just the product type that they're available in. One of the other things that could be a problem with an ETF, now if you're using highly liquid, very popular, normal ETFs that we tend to use, you're not going to have this problem. But ETFs, like stocks, if they trade very infrequently, the difference between what somebody's willing to pay versus what somebody's willing to receive when they sell, there could be a bit of a difference in between there. So if I am holding a stock and I only want to sell it for $100, but the next person on the market out of like 10 people only wants to pay 50, that's a big spread in between. So if somebody says, I just want to buy it whatever price, they're going to buy it for me at my 100. And if somebody says, I'm going to sell at whatever price, they're going to sell to that guy for 50. So that's what we call spread. ETFs can have this problem because you have to sell them to other shareholders if there's just not enough people partaking in the transactions of the fund. The difference could be a little wide. So mutual funds would be great in something like a tax-deferred account where we don't care about capital gains distributions. If we're not worried about having a current tax liability because it's deferred until we withdraw the money anyway, mutual funds are great for that. And like I said, you can get that direct dollar amount invested. So if you want to put exactly $10,000 in a mutual fund, you can do that, assuming you're not paying commissions on an A share. So again, just kind of looking at the comparison here, mutual funds trade on what's known as the primary market because you're trading directly with the people who create the product. ETFs are on the secondary market because you're one step removed from that and you're trading among all the other people on the stock exchanges. Mutual funds cannot trade back and forth intraday. You got to wait until the end of the day to get that calculated value, while ETFs can because the value is just determined on what somebody will pay for it. Mutual funds get a dollar amount holding because they can split up the shares fractionally versus ETFs, it's all whole shares. Mutual funds, you don't really care about volume or what the spread is because they'll just sell it to you for what it's worth, no question. Versus the ETF, if you've got very few people or low volume trading it, there might be some difference in the buy and the sell price. So with that, let's go to our set of slides for today. Let's see, we close this. Oh, right. There's the forum slide from earlier that I was supposed to show at the beginning of class, but so now we'll get through all this because we talked about all those. Okay, so now we're going to start with my favorite topic, and that's actually building portfolios. This is where I get to hopefully show off my knowledge really strongly. Yes. Yeah. So new portfolio construction, I kind of just came up with this term. New portfolio construction theory is basically just all of the different things that we use, all the information, all of the experience that we've had, and a lot of concepts derived from what's called modern portfolio theory wrapped up into the basis for how we select investments for our clients, for ourselves, and how we like to try and educate people. It's really a guideline to hopefully simplify portfolio building. It's a lot of information, it's a lot of data, it's a lot of things to understand. But once you get the basics down, you can kind of understand that there's a fundamental level where you can make something that works, and there's another level on top of that where you can maybe squeeze a little something extra out of it, and then you can have a little bit more fun once you understand the advanced concepts. But what we're really going to talk about is a couple key concepts. Firstly, the most important factor is using time to help select your investments. The more time you have before you need to use it, the more risk you can take. But the stronger your liquidity needs are, the less risk you can take. If I need funds tomorrow, I'm probably not even going to move it into my brokerage account because that would take too long to get it back out. I just keep it in my bank account. If I need it in a year, I might put it in there, or I might just buy a CD. If I need it in 5 years, okay, I might be willing to take on, maybe get some investment grade bonds, maybe a little bit of dividend stocks or something. If I don't need it for 15, 20, 30, 40 years, just put it in the S&P and look away, and that would be just fine. So using time is really important to help you select your investments, because if you get into something too volatile and you need it in 6 months and it drops by 30%, now you don't have the same amount of money that you need. It doesn't matter how well that investment's going to do over the long term because you were not able to fulfill what you needed. So there's 2 categories that we break down our portfolio construction process into, and that's what we call lateral integration and vertical integration. Lateral integration is simply called that because you're on a horizontal axis of time. How far away am I from my goal? I can take more risk. Is it really close? I can take less. And that's where we help define our risk tolerance. Vertical integration is really kind of our way of explaining diversification and to make sure that we are diversified through a bunch of different assets that have different types of risk, and really just make sure that we're not overexposed to anything in particular, and also making sure that we bias towards low cost. Because over the long term, one of the main determinants of performance is 1 asset allocation and then 2 fees paid. So if we can pay as little fees as possible, that's going to help us a lot in the long term. So I'm going to show you an example of sort of volatility as we're thinking with, again, that lateral integration. This is basically the same thing that I was saying, but let's say you've got an upcoming house purchase. You have $100,000 you want to put down on this property, and you have 2 investments to choose from. The first investment has a 95% chance of returning 3%, but it has a 5% chance of returning 1%. So, you know, you're not going to make a lot of money, but you're also not going to lose anything. Investment B has a 50% chance of returning 100% and doubling your money and doubling your budget, or it has a 50% chance of returning negative 50%. And so in this situation, which would you choose? Well, it's meaning you lose half of it. Well, we say upcoming, we mean like within a short period of time. So we're going to go to A, right? Because we don't want that extra volatility. If we were saying we're going to start saving for 10 years down the line, maybe I'd choose B. But if we're saving, if we're making sure that we need these assets available for our purchase, I'm going to choose the lower volatility. We're not going to earn as much as we could, but we're also not going to lose as much as we could. So that's why.
Dollars, yeah, I would. I'm going for B.
Right, but then this wouldn't even be a concern in the first place. Like that wouldn't even be part of the equation. Right, exactly. So the next thing that I want to talk about is what's called the law of large numbers. The law of large numbers is essentially, it's a statistical law that says if you're measuring some sort of population, whether it's people or some data points, the more and more data you measure, the closer the average of whatever you're measuring gets to the average of the entire pot. So it's a little bit confusing to understand, but thinking about it with insurance companies sort of simplifies it. So if I'm looking to insure this room against some sort of risk, let's just say it's life insurance. If I pick one person, just something could happen randomly. They could get hit by a car, anything could happen. And that risk is much higher to me if I only insure one person, or maybe some health problem comes up. If I insure a second person, my risk is now spread between the 2 of them. It's less likely that they're both going to have the exact same outcome and they're both going to pass and I have to pay out both policies. Add another, the risk goes down even more. Add another, and another, and another, and then statistically, my measurement of the probability of something happening to one of the people I'm insuring gets closer to the statistical average of the entire country. So more similar policyholders equals less statistical risk. That's why they're willing to insure you. That's why you can pay a couple $100 a month and then have a multi-$100,000 claim happen and they'll pay it out. Because statistically, that's not going to happen very often, and they're going to continue to make their money hand over fist for the rest of time. So the way that we use this in investing is when we look at return numbers. You will often hear something like the Dow Jones returns an average of 9% a year. And that may be true, but if you only look at 1 year, it's probably not true. If I looked at the year 2021, like, what are you talking about? It returns 20% a year. But if I looked at 2018, it's like, what do you mean? It loses money in a year. But then if I look at 2013, no, it goes up 28%. So when we're looking at returns like this, you have to be aware that if you're looking at volatile investments, in order to get that average number that they talk about, you have to participate in a lot of years. The fewer years you have, the lower your chances for your average return to be the average return that's been measured for the whole time. Because the average return for the Dow Jones Index has been 8.7% from 1998 to 2022. But it has only been really close to that 3 times out of all these numbers. Only 3 times has it actually had a return close to that average. Because an average return is not what you're going to get year over year. And that basically takes me to what is called sequence of returns risk. So if you're taking money out of an account and you're betting on 8%, 8%, but then you hit a year of negative 4%, that's a sequence that's different than you were expecting because you thought it was just going to be the same number every time. But these averages don't come from identical returns. They come from lots of different returns over a long period of time. That's why we use these stock investments for longer periods of time, because the short period, we got a chance of it going up 20, we got a chance of it going down 30. But over the long period of time, we have a much closer chance of it returning this average number smoothed out over time. So you can kind of see that in this slide from Morningstar. There's a reduction of risk over time with everything. So you've got 4 different asset classes here. You've got small stocks, which would be that small cap we talked about, large stocks, long-term government bonds, and treasury bills. Treasury bills are pretty much 1-year debt instruments from the Treasury, and they're very low risk overall, and they pay a nice little bit of interest, and then that's about it. But you can see that if you only held the assets for 1 year, the risk is way higher than if you move over to 20 years. For example, here on the small stocks, you have a possibility of earning 150%, but you could also lose 60%, and that's for 1 year. But if you hold it for 5 years, it's more likely that you'll return maybe 50 or lose maybe 20 or 25. But then if you hold it for 20 years, it squishes down even further. So this is, again, another example and another representation of why we hold stock investments for long term. We hold high risk for long term because the risk actually goes down over time because we get all of those years to average out, and that sort of positive skewness of the market that tends to go up over time because inflation goes up, there's more people, there's more products, things just keep happening. All of that contributes to the risk going way down over time. So how do we use this to our advantage? Well, we hold those riskier assets for a longer period of time, like I said. We use less risky assets for immediate needs, and we diversify across asset types. And we can also do something called dollar cost averaging. This is something that people really like. It's really good for accumulating. It's really good for people who are building an investment account, or for people who are, say, investing in a 401k. That's exactly what you're going to be doing with a 401k, is dollar cost averaging. And it's pretty much just saying, I'm going to invest this dollar amount at regular intervals forever. And if you do flat investment amounts at regular intervals, regardless of what share price the investment has, it means that you'll buy more cheaper shares and less expensive shares. So when you have a lot of market volatility, it actually tends to make your average cost lower because you're buying more of the cheaper shares and fewer of the expensive ones. If it just keeps going up forever, obviously that's not really going to happen, but you'll still benefit regardless. So again, the advantage for the system is just that the average cost of shares is low. The purchasing power has potential to be more efficient without the need for tracking the share price because, again, you buy more of the cheaper ones, you buy less of the expensive ones. So we'll take a look at an example of that in a bear and a bull market. So this is what happens if you invest $250 a month for a year in up and down markets. When the price is going down, the more it goes down, you're buying more of the cheaper shares, more of the cheaper shares, more of the cheaper shares, and your average gets to be nice and low. And even when we're going up in price, because you bought so many more shares when it was cheaper, as the market price tends to rise, your average cost is lower than that. So you get to buy a lot of shares when things are less expensive and not so many when they're super expensive. So that's dollar cost averaging. Next, we'll take a look at what we call time-based asset allocation, and that's really that lateral integration. Now, there's a couple different types of investments on here. These are not law. This is just the easiest way to understand it. This is kind of, if you just average everything out and you just want to make it super easy, this is kind of how you can think about it. If you have super short-term needs, cash and cash equivalents are your friend because you don't want them to go up and down a lot in value. If you have more intermediate term needs, bonds are pretty good because they're usually less volatile than stocks and they pay you a little bit of interest for your time no matter what happens. And especially with something like if you buy an individual bond and you wait until they pay you back the full amount, you just make your little bit of interest for staying there and you increase your assets by just a little bit just for being there. With the long-term needs, you can put your stocks in there, expecting that the stock market will grow over time, and you're willing to sit through that volatility because you don't have a need for it in the short term. So here's another slide from Morningstar that just kind of shows the spectrum of risk tolerance depending on what we're looking at. Cash alternatives sit all the way down here at the lowest risk and the lowest potential return. That's pretty easy to understand. If we move up to government bonds, because they're so well rated, because you know, the US Treasury is basically what we're allowed to call guaranteed, but I'll never truly say that. Corporate bonds are one step up, large stocks one more, international stocks, and then small stocks with the highest potential risk, but the highest potential return. And again, yes.
Small stocks, small cap.
Yes, exactly. Yeah. So whenever you hear small cap, mid cap, large cap, that's just same thing. It's just the size of that company. Yes.
Lots of savings T-bills.
Yes. So the Treasury will be part of the government.
Has there ever been a time in US history when the bonds didn't, like, whatever you call it, crash?
Where they like defaulted or something like that? I don't think so. No, no, no. You can have the value of a government bond drop.
5 or something. That's possible. The Confederate dollars went to nothing or something like that. But generally in modern history, let's hope.
Yeah. Yeah, so you can have bonds crash in terms of value because if interest rates change and your bond's only paying 5, but they could get 6, then the value will go down because they need to pay you a comparable amount as if they were buying the new bond, but they've never defaulted. So that's not something that at least we've seen in modern history, like you said. So the next thing after thinking about time-based allocation is diversification. So diversification is really simply the process of minimizing exposure to any single risk by combining multiple assets of different types and exposure in a portfolio. The easiest way to understand this is through stock diversification. If you own one stock, you'll have a certain level of market risk. And no matter where you are, you're going to feel this market risk because as the market moves up and down, stocks are going to move up and down. But if you only have one stock, you're also exposed to what's called company risk. And there's a lot of different versions of company risk. There could be a CEO that tweets a lot. Sound familiar? There could be accounting errors. There could be horrible financials. They could go into a lot of debt. They could be in the wrong industry at the wrong time. All sorts of different things. But if you're concentrated in one stock, that company risk is really high. You move to a second stock, okay, it drops a bit. To a third, it drops more and more and more until you get all the way to 100, 1,000, tons of different stocks. And that company risk goes down so minimal that it almost doesn't affect you except for what percentage of that stock is of your portfolio. So this is why we like index funds. This is why we like passively managed funds and just different types of funds because they take care of that diversification for us for the most part. We still have to pay attention to what's in there, but as long as we understand that I want to buy some stocks, you could just buy the S&P 500 and you don't have to worry about one specific company bringing your entire portfolio down. That would have to take a lot of concentration. So there's different types of risk that we can have. There's two main types of risk, one being systematic, which is something you can't diversify away from, and one being unsystematic, which is one you can diversify away from. That company risk would be considered unsystematic risk, versus that market risk would be our systematic risk. So unsystematic risks are things like accounting, business, country, default, executive, like all these different things that a single company or a single bond or a single investment or a single country could face. Versus systematic is just, that's just the value of things going up and down in general, averaged across everything. So things you can't diversify away from is purchasing power risk. If inflation goes up ridiculously and your investments don't follow suit, there's not really anything you could have done for that. Reinvestment rate. You can't diversify away from reinvestment rate because if you can't reinvest at a better rate and you're stuck somewhere, there's just nothing that you're going to be able to do to get away from that. Interest rate risk. If interest rates change out in the marketplace, unless you're just not in bonds at all, it's kind of hard to get away from the fact that your bond pays a certain amount and new bonds pay more. Your bond's not going to be worth as much. Market risk is just simply the risk that we take for being in the market at all. Stocks go up and down. It's part of the game. It's why you can make money in the first place. That's the risk that we kind of want to have if we're trying to grow. An exchange rate. You know, if you're exchanging from some other currency to your currency, there's not a lot that you're going to be able to do to diversify away from that unless you just never deal with that country ever. But global economics are intertwined. It's hard to get away from that. So you can't diversify these risks away, but they can be managed. And that's why we use things like lateral integration. Because if we want to manage our market risk, maybe I want to be more in cash and I want to feel less market risk. But if I want to use market risk to my advantage to grow my assets, I'm going to get all the way invested. So how do we address these risks? Well, with those systematic risks, we manage exposure and allocate position categories based on time. We don't think about what's going to happen out there, or what different regulations are being put in place. We might consider that, but the number one thing is we want to make sure that if we're using volatile assets, it's for long term. And if we're using stable assets, it's for short term. For those unsystematic risks, break down the allocations with multiple specific assets. Index funds can do part of that for you, but it's making sure that you're not super at risk to any one single thing happening. If you're in just a technology fund, financials could do great, healthcare could do great, but you won't ever see that benefit. Technology could do really horribly, and you're going to feel all of that. You're going to feel the brunt of that happening right in your portfolio. So managing unsystematic risk, it really gets simple to just diversify around, but limit your exposure to any one type of risk. Accounting, business, these are just all different ways of saying company risk. So don't put all your eggs in one basket. Don't buy just Apple stock. If you're willing to take that risk and accumulate on the way, or you've got a company plan that gives you company stock, that's great. But if you're trying to build a diversified, balanced portfolio, don't buy all one stock. For country risk, don't just buy a Japan fund, buy a diversified international fund, diversified developed markets, emerging markets. For default risk, the risk that somebody does not pay a debt back, diversify among bonds. Don't just hold a single low credit rated bond. Lean towards high credit quality, or use bond funds, again, that do this for you. For government and regulatory risk, again, just making sure that you're diversified among the sectors. If you're really strongly in energy, and it looks like regulations are about to come down on energy, you might feel some extra volatility with that, versus if you were spread out across all parts of the market, you wouldn't feel all of that risk all at the same time. For managing systematic risk, for purchasing power, don't leave your cash in cash if you've got time. If you can be in something that gives you interest, take the interest. If you're in a savings account that pays 1% versus a money market that pays 4%, there's not a lot of risk with that money market, and you can earn an extra 3%. Reinvestment rate. If you've got a really good rate for you, it's impossible to see the future, but if you've got a rate that can produce something that you want, for example, you're buying a bond and you want a certain level of income, if you get that level of income, you can lock it in with a longer term bond, particularly with a treasury bond. Then that way, you don't get into a place where your bond expires and now suddenly you have to buy a much lower interest rate bond. With interest rate risk, keep the duration low. We'll talk about what duration actually means a little bit later, but it's simply a measurement of how sensitive your bond funds are to the interest rate. So the lower that is, the less your bonds will move up and down in value. For market risk, allocate with time in mind. Make sure that you're paying attention to how long you actually have for each of your goals and allocate alongside that. For exchange rate, diversify among those foreign countries. Make sure that you're not too invested into any one particular country. So let's go back over that. Just make sure that we got what we were talking about today and go through some of those concepts one more time. I know, this is the first time. So we started with basically talking about how we break this down. So again, making sure that laterally we're looking at that time frame, that time horizon. You could even, if you just picked index funds, I wouldn't even be that worried about this diversification point as long as you know that those funds are diversifying for you. You pick your cash, you pick your intermediate term needs, you pick your long-term needs, and you can do really well focusing really strongly on that part. But then you want to add some more diversification and really make sure that you're not too far in any one sector. And that's what you use the vertical integration for. Making sure that you really use the time horizon to dictate your level of risk. Day-to-day positive and negative returns statistically average out to a positive expected outcome. That's why every time we talk about, when people like to bring up what's happening in the news or all these sorts of things, yes, they can really increase short-term volatility. Things can get really hairy in the short term. But time and time again, you give it some time, you move forward, and things tend to even out. They tend to figure out how to work, and then they continue growing. Because when the stock market implodes and everything explodes, we're going to have much bigger problems than getting our money out of our brokerage accounts. And again, just kind of to summarize, all of that is really just saying, if you need liquidity, be risk off. If you need growth, be risk on. And that's kind of as simple as it is. And again, if we look at things like asset class returns, this is kind of looking at the difference between the compound annual, which is if you look at every single year, if you look at that and you average the return every single year versus the highs and the lows. The reason that you get an almost 12% return with small cap stocks is because you had times where it was up 150% and times when it was down 58%. The reason you get a compound 10% return with large stocks is because it has times of being up 54 and times of being down 43. So yes, there are going to be times where volatility goes crazy and there are going to be huge swings, but that's part of what contributes to those compound returns. Oftentimes, a lot of the best returns come from right after the big recessions. And most people make the mistake of not participating during that, or thinking they wait for the signal of when it's going to go back. And then they go, yes, here it is. And they missed out on like the best section of that recovery. And usually you participate the best when you just sit there and wait it out. And that's where people get the best average returns. Time and time again. Happens over and over and over again. There's so much data to back it up. Same thing for all these other things. And you can see the T-bills. They only drop just a little bit. They just drop 0.02% and they go up maybe by 14% at the top end. And they average out to 3%. Yes?
Change that interest rate changes every quarter, right?
Yes. So this is not representative of the interest rate change. It's simply the interest rate is part of that return, but there could also be increase in value or decrease based on, this is just kind of saying total return, like how much money it makes, period. So the interest rate will be part of that. This is just kind of looking at that long time period and averaging that out over every single year. Right, exactly.
And pointing out the obvious, now we have that timeline advantage.
Exactly.
Yes.
Exactly. So that's another reason why it's important to use these concepts so that you can allocate properly for that short term and not take on too much risk for what you're trying to achieve. Yes.
There's inflationary bonds, right?
Yes.
And our inflation's gone up like 3% I hear just recently. So is this a good time to invest in inflationary bonds?
I know you've got some opinions on those.
Well, I've tried them before. The problem is they're kind of, if interest rates go up, you'll get an inflation bump, but the bonds go down in value. So I've never really seen them other than some very brief times be good. Now, the exception to that would be Vanguard's short-term inflation protection bonds, TIPS. for the short term, but then if rates fall, your yield will go down. And if inflation doesn't go up, you don't get any return. So they haven't worked out. I've tried using before, that sounds great, but at least do the short term. So if rates do go up and you need the inflation bump, then you protect the downside of the bonds. But that's the work part.
Yeah. So then again, with vertical integration, that's basically how we're trying to address things like systematic and unsystematic risk, making sure that we get away from diversifiable security specific risk. I don't want to have all of Apple's risk. I don't want to have all of Visa's risk. It doesn't matter. I just want to be diversified across as many of those different companies and securities as I can. Again, showing this example of what happens when you add more stocks. When you've got only one, you get all of that company risk. And when you've got hundreds or thousands, it's so small, it's almost doesn't affect you, period. So that's just one of the really good reasons where the outsized returns come from taking the outsized risk, but the outsized risk is outsized risk. It's way more risk than you might be comfortable taking, or you might be able to mathematically take for what you're trying to do. So with all of that, any questions or comments based on everything today? There's so much information. There was a lot, but if you've got anything, the most basic or the most complex of questions, throw them out.